Hello and welcome to Chapter 6. It's all about intercompany inventory and land profits, and you're responsible for all the material in that chapter. This really gets into the tricky part of consolidations. Hopefully it'll make sense and we go over it. Okay, so first a bunch of theory and discussion. So Chapter 6, we've moved away in Chapter 5 from just the balance sheet at acquisition. We've gone years past. So this discusses how to deal with transactions that occur between the parent and the subsidiary. We've had a couple of them in the past. We've had where one owes the other one money and when there's dividends. So when we did one owes the other one money, we didn't have any interest, so it was just the balance sheet. So it was quite straightforward. But this one, it takes it just the next step. Okay, so obviously in a consolidation, intercompany transactions must be eliminated. If one party is selling to another party on their own single entity statements, that's perfectly fine. But if we draw our little consolidation circle and we have the parent and the sub and they're making sales to each other, can we count all those sales? Well, we can. Why? Because they're within the circle. So if you're just in your circle moving stuff around the inventory and saying, oh, well, we changed the money, so now we had profit, doesn't make sense, okay? So the problem is we're in the circle and we're assuming that it's one entity. So one entity can't sell to itself. Okay, and I'll show you with some numbers down at the bottom. Consolidated statements can only be the result of transactions that have taken place with entities outside the group. So if these guys are selling outside the group, or buying from outside the group, sorry, I did that up here. If they're selling or buying from outside the group, that's okay. Those are normal transactions, and you see one going outside. So they make a sale, that's good. It's just if they sell to here, you can't have a sale to yourself when you're one entity. Okay? So in Chapter 5, we've already dealt by dividends paid by the sub and loans, types of transactions. We're also introducing taxes. So taxes are going to be in here. So that will change things a little bit too. Okay. So we're going to do several more types of transactions. Intercompany purchases and sales are big ones. And we'll do some other things. So the examples we're doing right now and any other intercompany revenues and expenses. Yeah, and we can have assets and liabilities. But we dealt with notes receivable, notes payable last chapter, so that's why I mentioned this specifically. Anyway, I call them basic transactions, okay? Because they're simple to deal with. So they're easy to move. They're eliminated to ensure revenue is recognized only when it is earned with a party outside the consolidated entity, and to stop double counting revenues and expenses. Now, this will have no effect on the calculation of non-controlling interest in the income of the sub. It's no change to overall consolidated net income. Plus, there's no change to income tax because changing consolidated and expenses by the same amount does not change consolidated net income. So, I'll show you what I mean here. If we have revenue, let's say 200, and I'm just making these numbers up, expenses of 150, our net income is 50. Now, let's say I take both down by $60. So you'd pay on this 50. If I take both down by $60, we get 140, 90, which gives us 50. So these are the same. So there's no difference in tax nor NCI, because NCI comes from the income statement and it didn't change the income. Okay? So these are all basic till I tell you they're not basic anymore. And I'll tell you what that means, or we'll give an example so you can see. Okay, so when the parent sells inventory to the sub, who then sells inventory to an outsider, we have to eliminate any intercompany portion of the eventual sale. Okay? So we do that by eliminating the parent's selling price of the inventory from the sales account on the income statement and the subsidiary's purchase price, which is the same as the selling price of the parent, from cost of goods sold. You know what? You can read that. I'm going to example, which I think might make a little more sense. Okay, so let's say P manufactures an item for $6 and sells it to a sub for $10. Then the sub sells this inventory to an outsider for 15. Okay? So this is our example. So just take a sec, write that down. Okay, so we're going to have the parents' books, subs' books, and then we're going to get to consolidated. So we'll have revenues minus cost of goods sold gives gross profit. So okay, so on the parents' books, they create it for 6, they sell it for 10, and that gives them 4 of gross profit. Okay? The sub buys it for 10 and sells it for 15. Okay? So if we add them together, we would get 25 minus 16, which 9. On their separate company books, if you separate them, that is totally right. Okay, nothing wrong with that. However, I'm running out of colors here. If we a circle around them and they become one entity, then for consolidation, we've duplicated some of that. Okay? So, and this is parent, just like right reminder, parent cells. So, we have this duplicated. So that's what we need to eliminate. And to do that, we're going to take revenue or sales down by 10 and cost of goods sold down by 10. Otherwise, revenue and cost of goods sold is too high, because if this was one entity mushed together, those 10s would essentially cancel out, and it would be 15 minus 6, which is 9. Okay? So for consolidation, we're going to do down by 10, down by 10. So for consolidation, we're actually going to get 15 minus 6 is 9. So that's right. That is wrong. Now, your income ends up the same, so there's no change in income tax, but it's just you're counting this and this. But this was a sale to yourself, so you can't have that. And this was a purchase from yourself, so you have that. So we're going to get rid of those. Okay? And notice, because same, no effect on tax. So why I call this basic is because you do the same thing to both accounts. Okay? So, does that make sense? So I'm just going to write that down. Basic transactions do the same thing to both accounts. No change in net income, no change in taxes. I'm just going to recap, okay, because sometimes this gets in your head. Here's the parent selling to the sub. On their own, it's perfectly fine. But we go to consolidate and just add them together. Well, this really isn't a sale because I just moved it over to myself. Because remember, we're pretending it's one. So I can't count that. And this came from someone else, so I can't count that, so I just book in. Does that make sense? Okay. And with this, the key thing is if it was sold to an outsider.